Imagine reaching into your wallet right now, pulling out a $20 bill and asking a single question. Who decided this piece of paper is worth anything? The answer leads somewhere most people never look, not to a founding father, not to a Revolutionary-era institution, but to a war. A war that broke the old system entirely and replaced it with something new, something designed not for you, but for the government that needed to survive. Here is what almost no one teaches in school. For the first 70 years of the American Republic, there was no unified federal banking system, no centralized authority dictating how money was created, no standardized national currency flowing from Washington outward. The system that exists today, the one so deeply embedded in daily life that we never think to question it, was not the original design. It was a wartime replacement. And the old system it replaced? It worked. Cast your mind back to the early 19th century. The United States is young, restless, and expanding at a speed that astonishes the world. Cotton fields stretch across the South, factories rise in New England, immigrants pour into port cities by the thousands, canal networks knit together distant regions, and between 1830 and 1860, the railroad network explodes from barely 24 miles of track to more than 30,000. All of this economic machinery was running without a permanent national banking authority. What existed instead was something messier and far more interesting. Across the country, thousands of banks operated under state charters. Each one issued its own paper currency, notes promising redemption in gold or silver at the issuing institution. A farmer in Ohio might carry notes from a Cincinnati bank. A merchant in Baltimore might hold paper from a Philadelphia institution. None of it was standardized. None of it was federally guaranteed. This sounds like chaos, and yet the numbers tell a different story. The American population roughly sextupled between 1800 and 1860. Cities materialized out of wilderness. Capital formation accelerated. European investors sent money across the Atlantic to fund American railroads and industry. If the financial system was truly dysfunctional, none of that should have been possible. The reason it worked, at least well enough, is that markets adapt. Merchants learned which banknotes to trust and which to discount. Weekly publications called banknote reporters circulated through commercial districts, listing the reliability and exchange value of notes from hundreds of institutions. In major cities like New York, private clearinghouses allowed banks to settle mutual obligations efficiently, netting millions of dollars in daily transactions without any federal intermediary. During the Panic of 1857, these clearinghouses stepped in and stabilized the interbank payment system almost entirely on their own. This was not the absence of financial sophistication, it was a different kind of financial sophistication, horizontal, distributed, and rooted in local knowledge rather than federal command. Before the Civil War, the idea of a permanent national bank had already been fought over and decisively rejected, twice. Alexander Hamilton's first Bank of the United States was chartered in 1791 and allowed to expire in 1111. Critics feared it concentrated dangerous financial power in private hands. 5 years later, the Second Bank of the United States rose to take its place. It was larger, more influential, and more controversial. When President Andrew Jackson declared war on it in the 1830s, he was tapping into a deep vein of American suspicion toward centralized monetary authority. Jackson saw the bank as a vehicle for the wealthy elite to exercise undue control over the republic. By 1836, it was gone. So, for roughly a quarter century, from the death of the Second Bank through to the outbreak of the Civil War, the United States operated under the free banking era. Thousands of state-chartered institutions, competing currencies, private clearing networks, and no central federal authority over money creation. Then, in April 1861, the guns opened at Fort Sumter. Modern wars are expensive beyond all historical precedent, and the Civil War was no exception. Federal spending in 1860 sat at around $63 million. By 1865, that figure ballooned past $1 billion. Armies needed feeding, artillery needed manufacturing, the railroads carrying troops and ammunition needed financing. The scale of the fiscal challenge facing the Union government was staggering. Treasury Secretary Salmon Chase faced a problem with no easy solution. Taxation could not fill the gap. The answer was bonds, government debt issued in enormous quantities and sold to banks and citizens alike. The financier Jay Cooke mounted one of the largest public bond campaigns in American history, appealing to patriotic sentiment to drive purchases. But bond campaigns require reliable institutional buyers, and with thousands of independent state banks answering to state regulators rather than Washington, there was no guarantee that capital would flow toward federal debt in the volumes required.
The National Banking Act of 1863 solved that problem directly. Under the new law, banks seeking a federal charter were required to purchase U.S. government bonds and deposit them with the Treasury. Only then could they issue standardized national banknotes. The more federal bonds a bank held, the more currency it could put into circulation. In a single legislative stroke, money creation was tied to federal borrowing. Banks had a structural incentive, indeed a legal requirement, to finance the war. 2 years later, in 1865, Congress moved to eliminate the competition. A 10% tax was levied on all state-issued banknotes. The tax was not punitive in name only, it was punitive in effect. Within a short period, the diverse ecosystem of state currencies that had circulated for decades simply vanished. The Supreme Court upheld the tax in 1869. The old system was not outcompeted, it was taxed out of existence. Official accounts frame this transition as modernization. The chaotic free banking era, the story goes, finally gave way to an orderly national system. Progress arrived just in time to save the Union economy. But pause on several details that this narrative quietly ignores. First, the panics did not stop. The Panic of 1873 devastated banks and railroads. The Panic of 1893 triggered one of the worst depressions the country had seen. The Panic of 1907 nearly collapsed the entire financial system and directly prompted the creation of the Federal Reserve in 1913. If centralization was the cure for financial instability, it took a very long time to work and arguably never fully succeeded. Second, private mechanisms had already been developing to address the very problems that centralization claimed to solve. Clearinghouses were settling interbank obligations at scale. Discount markets were pricing currency risk efficiently. The system was not frozen in its 1837 form, it was evolving organically. Third, consider what the 1863 reform actually created at its structural core. Currency issuance was now tied to federal bond holdings. Banks' balance sheets were anchored to Treasury securities. Financial institutions became stakeholders in the stability of government debt markets. Washington gained a captive pool of demand for its borrowing. Was the goal monetary uniformity, or was it something more specific, a reliable mechanism to absorb wartime debt at scale? 50 years after the National Banking Act, the Federal Reserve Act of 1913 deepened the architecture further. A central bank with authority over monetary policy and the power to act as a lender of last resort was installed at the apex of the system. Crisis had again accelerated centralization, and the groundwork laid in 1863 made that transition not just possible, but almost inevitable. The pattern across American financial history follows a consistent logic. Crisis arrives, centralization is proposed as the remedy becomes permanent, the previous system is remembered as primitive. But remembering clearly matters. The free banking era was not a void, it was an alternative, imperfect, adaptive, and fundamentally different in one critical way. The money flowing through it was not structurally tethered to federal debt. Banks answered to states and shareholders, not to Washington's fiscal calendar. Financial authority was dispersed across thousands of institutions rather than concentrated in a national framework. When the Civil War created conditions that demanded a different arrangement, that alternative was not simply reformed, it was replaced. Here is the conclusion toward which all of this evidence points. The National Banking Act did not create American banking from nothing. America already had banks, more than 1,000 of them by 1860, financing the most dramatic economic expansion in the nation's history. What the Act created was something more specific and more consequential, a banking system structurally integrated with federal debt. Once that integration was established, it proved remarkably durable. Bond holdings tied to currency issuance, national coordination replacing state-level pluralism, standardized notes carrying federal credibility. The architecture installed under wartime emergency became the permanent operating system of American finance. And the free banking era, messy, distributed, and independent, faded from memory, surviving mainly as a cautionary tale about disorder. But disorder and decentralization are not the same thing. The system that existed before 1863 had real flaws. It also had real virtues, virtues that rarely appear in the simplified version of the story. The question worth sitting with is this: when crisis compresses deliberation, when urgency justifies consolidation, do the institutions built in those moments reflect what a society would choose in calmer times? Or do they reflect something narrower, the immediate needs of a government fighting for survival? In 1863, the answer shaped American finance for more than a century. Understanding it clearly is not nostalgia, it is clarity. And clarity about the architecture of money is never a small thing.